In this week's video, we'll review the latest charts and data to help us answer the question, are institutions shifting to a defensive stance before the election? We'll be moving quickly, so feel free to use the pause button on your video player. Before we view these same scores the Friday before the election, November 1st, 2024, let's link back to the scores July 19th of 2024. Those scores told us that the trend was still intact, and we should try to treat all volatility as normal volatility within the context of an existing uptrend. How do the same scores look today? The answer is almost identical, and thus the message is almost identical. But given we have an election next Tuesday, let's take a look at daily charts to see if any cracks are starting to appear. The chart on the left side of your screen is XLK, the technology sector, a subset of the S&P 500 index. We're looking at the 20-day moving average in blue all the way out to the 250-day moving average in black. This is the topping process that we would like to avoid. This is late 2021 here, early 2022. Thus, if market participants were starting to get concerned, we would expect to see something like this in the present day. How does that same chart look? Better, worse, or about the same? Well, relative to February and March of 2022 down here, the answer is better. If we move back to the left side of the screen, 2021, we can make an argument that this point A here, this low above a rising 250-day moving average in black, similar to this point A here earlier in 2024. This is April of 2024. And we can also make an argument that this point B over here on the left side of your screen in early 2022, where price comes down near that upward sloping 250-day moving average, is similar to this point B over here in early August of 2024, which means at this point, we've got a trend that's starting to weaken. But if we look at what happens next, this is where they start to diverge. Point C here, the next move, is a higher low, and that occurred in early September. Compare and contrast this point C on the right side to this point C here. This is a significantly lower low relative to point B, and point C is significantly lower relative to point A. That is not what we have in the present day. On the right side of the screen, point C is higher than B and higher than A. And from a trend perspective, you can see in 2022, the moving average cluster started to roll over in a concerning manner. The 250-day moving average in black started to flatten out, which really doesn't look anything like the right side of your screen. Look at all of this consolidation and volatility in the isolation chart for XLK, the technology sector for the S&P 500. All of it is occurring above an upward sloping 250-day moving average in black. That's in stark contrast to what's happening here in January, February, March, and April of 2022. And after this window here, really bad things happened. It's also noteworthy, if you go back to this point A here, and remember we said that this point A on the right side of your screen, similar to this point A here, in both cases, we retake this high here, but then what happens after that is quite a bit different. When we break below this prior high here, it acts as potential resistance and eventually acts as resistance. We poke above it here and we poke above it here. That's almost the polar opposite of the right side of the screen. We poke below it here and below it here. This is a short stay, a short stay. This is a short stay and a short stay. This resolves in a bearish manner. The odds tell us that this will most likely resolve in a bullish manner. We're not making any assumptions. Commentary is based on the chart in front of us, but the right side of your screen looks a lot better than Q1 of 2022. And a trend is a trend is a trend. It's going to look similar when the trend rolls over regardless of the reasons. So we have CCM market model trend strength numbers, dual 100s, all time frames, and then a longer term time frames only. We have very strong scores in the CCM secular volatility model. Is there anything else that's relevant heading into the election that might calm us down a little bit? The answer is yes. Our friend Dean from Sentiment Trader, his Twitter handle here, Sentiment Trader's Twitter handle to the right. From Dean, the 10-year Treasury yield has risen more than 65 basis points over 30 days. It's only happened a handful of times. And typically, if you're patient, at least historically, really good things happen when you looked out 12 months. The average gain in the S&P 500 was 22.8%. The median gain was 24.6%. Every single case, patient investors were rewarded because the market was up every single time 12 months later. Another relevant study from Dean and Sentiment Trader. Key points down here. RSI for Bitcoin shifted to a favorable position, triggering a buy signal for the cryptocurrency. After similar signals, the S&P 500 a year later, median gain 14.2%, communication services 28.9%, consumer discretionary 17.3%, and tech a satisfying 24.7%. Relative to previous signals, the S&P 500 a year later was higher in 80% of the cases. Same can be said for the tech sector. 80% of the time it was higher, again, with the median gain being 24.7%. And notice, it doesn't necessarily mean it's a cakewalk in the short run. It doesn't necessarily mean it's a cakewalk in the short run. But the numbers on your screen here as of November 1st, and the two signals that we just covered from Dean, tell us to keep an open mind about better than expected outcomes, and the strength of the trend allows us to try to be patient. Now let's go through the same analysis, but this time we'll look at the S&P 500. A trend is a trend is a trend. You can see the rollover process for the entire S&P 500 is similar to the look for the rollover process that we just covered for XLK, the technology sector. During the session on Friday, November 1st, 2024, the S&P 500 was trading above an upward sloping 50-day moving average in red, and we still had nice separation relative to the moving average cluster. This still looks like a strong uptrend. The look of price relative to the moving average cluster really doesn't look anything like this spaghetti rollover mess here in January, February, March, and April of 2022. Everything that we just said relative to the S&P 500 chart applies to growth stocks as well. SCHG, rollover process, left side of your screen, present day with that strong trend look on November 1st. In fact, here, late in 2021, SCHG, as in George, was unable to print a new closing high. We have printed a new closing high on the right side of the screen, exceeding this high here from early July. All of this consolidation in 2024 in recent weeks and months occurring well above an upward sloping 250-day moving average in black. This consolidation relative to the 250-day really doesn't look anything like this consolidation relative to the 250-day in 2022. You can see the rollover process for XLC, Communications Services sector for the S&P 500, took several months heading into 2022. On Friday, November 1st, we have a full-bore bullish look with blue, the fastest moving average, the 20-day on top, black, the slowest moving average on the bottom. Prices above all the moving averages and the slopes of all the moving averages are up. This is in stark contrast to the look here early in 2022. Blue, the fastest moving average, is on the bottom, and in here, black, the slowest moving average, is on the top, and the slopes are rolling over. This really doesn't look anything like this. Similar situation with SMH Semiconductors. All of this consolidation in recent weeks and months is occurring well above an upward sloping 250-day moving average in black. Point A and point B here. Point B is slightly higher relative to point A. This and this looks significantly different relative to this and this, with point B over here being a significantly lower low on a closing basis. If we use this as a reference point here, we say this is similar to this. Notice most of the consolidation in here occurs below the red line. Most of the consolidation over here occurs above the blue line. This eventually resolved to the downside. The odds say that this most likely will still resolve to the upside. Not making any assumptions, we're taking it day by day. If you're concerned about a deflationary recession, or you're concerned about an inflationary recession, this is the type of look that we would want to avoid. If we're going into a recession and earnings are about to take a hit, all things being equal, you would prefer to be in relatively defensive 1 to 3 year treasuries relative to the S&P 500. This is that rollover look in early 2022 that we want to avoid. Present day chart really doesn't look anything like that. This does not look like a chart where market participants are running for the exits or slowly migrating to a defensive stance. Similar situation here. This is the inflationary bear market example. You can see when the government was mailing out checks every other day and printing money hand over fist, market participants started to get concerned about inflation in late 2020, and XLK started to underperform XLE significantly. You can see we get a leg down here, and then we get another leg down in the ratio in early 2022, telling us that market participants were still concerned about inflation in January of 2022, and that was the case in October of 2022 as well. Notice the slope of the 250-day moving average in black as we walk forward to this low in 2022 and contrast it with the slope over here in late 2023 and into the present day, November 1st of 2024. XLK is still making a series of higher highs and higher lows, and all of this consolidation in here is still occurring above an upward sloping 250-day moving average in black, which is significantly different relative to this rollover look in here. If we come back over to the right side of the screen, look at the slope of price over here looking back several months. Look at the slope of price or the ratio in here in early 2022. This really doesn't look anything like this, and all of this consolidation here occurring above this high from 2023. This is a good reference point here. This acted as resistance. Over here in recent weeks and months, it has been acting as support. Shifting gears back to the credit markets, the rollover look here, high yield bonds, JNK relative to SHY, 1 to 3 year treasuries. This is a defensive look here where credit investors are starting to get concerned about numerous factors: inflation, interest rates, and a potential hit to earnings, and longer-term concerns potentially about default rates. We can see the strength of the trend here. The ratio here almost comes down and hits the 250-day moving average in late November 2021, and eventually we pierce right through it here in late January, early February 2022. Notice how strong the trend has been in 2024, with this low here, this low, and this low, all occurring well above an upward sloping 250-day moving average in black. This really doesn't look anything like this. In January of 2022, ITB home construction dropped like a stone here, quickly dropped below the 250-day moving average in black. We really don't have anything like that during the trading session on Friday, November 1st, 2024. What does it look like when institutions are shifting to a defensive stance? Here's one example here, SPY, the S&P 500 ETF relative to XLP, defensive consumer staples. You can see a shift here in the ratio in January, very early, possibly even the second trading day of the year. The ratio drops below the 250-day moving average in black. We've had some consolidation in here in the same chart, but right now, price is above an upward sloping 20-day moving average in blue and above an upward sloping 250-day moving average in black. Concerns would increase if this ratio moves back into this area here, especially if it undercuts this low here from early September of 2024. That may happen very, very soon. It hasn't happened yet. Thus far, this looks like a short stay below an upward sloping 250-day moving average, and this looks like a failed attempt here in 2022 to recapture that same 250-day moving average that was rolling over here, in contrast to the holding up well look over here. This is the rollover process for risk-on oriented Bitcoin, sometimes used as a proxy of liquidity expectations in the market. You can see Bitcoin to the US dollar dropped below the 250-day moving average early in January of 2022. We've been consolidating in here. Thus far, it looks like we're trying to resolve to the upside. We've got a very tight moving average cluster here, and right now, unquestionably, it looks like it's trying to break to the upside. Why can we say that? Well, this is the 20-day moving average here. During Friday's session, Bitcoin to the US dollar is above that 20-day moving average, and we still have a 250-day moving average in black with an upward slope. The outlook for this chart will change significantly if we can exceed this high. That would be bullish. But if we exceed this low here, the longer we stay in this region here, the more concerning it would become. Leveraged, read risky loans. A very long-term topping process here in late 2021, early 2022. We come up to a tight moving average cluster and fail here in 2022, and then really bad things happen. Present day chart, what does it look like? It looks like a strong, existing, and ongoing uptrend. Relative to concerns about the economy and potential bond defaults or loan defaults, this really doesn't look anything like this. If we look at growth-oriented discretionary stocks relative to defensive-oriented consumer staples, XLY relative to XLP, in January of 2022, the ratio made a new 3-month low. That rollover look, failure in here. We are making a new 3-month high on the right side of the chart over here. And look at the improvement in the ratio since this August slowdown here. XLY in isolation drops like a stone in January of 2022. It's not what we have over here early in November 2024. Prices above the 20-day moving average and well above an upward sloping 250-day moving average in black. This really doesn't look anything like this mess over here in 2022. This is low volatility stocks within the S&P 500 index relative to the standard index, SPLV relative to SPY. You can see the defensive ratio picking up steam here in January of 2022. This really doesn't look anything like this over here. We haven't made a new high in this ratio for several weeks. SPLV has been a laggard for a long time. It's trying to show some improvement. That if we contrast the chart on the right side of the screen, the same chart with SP low volatility or SPLV in isolation, look how strong the chart of a laggard looks in isolation. It says a lot about the S&P 500 and the broader market. It's a broader look of consumer staples. Now we're looking at a monthly chart with the 7-month moving average in red all the way out to the 52-month moving average in pink. This is an increasing fear turn look here in late 2007, early 2008. An increasing economic fear look here slowly developing 2014 into 2015 until the S&P 500 peaks in early February of 2016 here. You can see the spike in fear in late 2021 into late 2022 here. Point of the exercise, this turn here, and this move here really don't look anything like November 1st of 2024. This says a lot about this. We had a very weak payroll report on November 1st. That would potentially be the bad news. The good news would be that the odds of a Fed rate cut increased last week, about 96%. The end of this week, about 98%. Keep in mind, we have a Fed statement coming right after the November 5th election. The Fed statement is on November 7th. We have a favorable environment where the Fed is now reducing interest rates. We don't want to let fear of what might happen around the election to cause us to make changes. We need to see a shift in the weight of the evidence. We just don't have that yet. These numbers are telling us to try to relax and see how things play out with an open mind. Dean's study number 1 is telling us the same thing. Something that just happened is telling us to try to be patient and think about longer-term outcomes. To try to be patient and think about longer-term outcomes. We don't want to get too cute. We don't want to overtrade. And we don't want to make any assumptions about anything heading into next week. Still have to get through the election, the remainder of earnings season, and the November 7th Fed statement and press conference. We don't have anything in hand today that contradicts the secular trend thesis. But since we know things can change at any time, it's extremely important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.